Welcome everyone to today's new showcase with Avsia. It's a pleasure to be hosting you once again for this very interesting presentation today. As you can see, we have not one but two speakers with us. Ruth and Andrew will be giving us a little bit of their expertise on tips and tricks to build a strong financial model for CNI projects in Africa. And I'll just be sharing my screen. We'll get started in just a few moments while more people are joining us. Very good. So welcome again for those of you who've just joined. As I mentioned a few moments ago, exciting webinar again. We're talking about CNI, one of the hot topics in our African solar industry. And at the same time, we're talking about financial modeling and tips and tricks to help you get your projects financed and get better and more constructive discussions with your financing partners. And for this, we have two wonderful speakers with us today, Ruth Mutoni and Andrew Gitaiga, both working with Odyssey Energy Solutions. They will tell you a little bit about the company in a few moments. Before I hand over to them, let me just do a quick word of introduction about our speakers today. First of all, I would like to introduce Ruth. She's the investment associate at Odyssey, coming with almost 10 years of experience in project finance and private equity. Before Odyssey, she was working with Mirova Sun Funder, where she's been deploying two renewable energy private debt funds. But she also has a strong track record in real estate private equity. So it'd be interesting to know a little bit the differences and the similarities. And she has studied at the Kenyatta University in Kenya. And if I'm not mistaken, you're also holding a CFA level 3. Are you currently finishing or do you already have it?
Yeah, I'm a candidate, so I'll be sitting for the exams in a few weeks' time.
All right. Well, all the best with this. I know how excruciating this can be. And our other speaker today is Andrew. Andrew is the investment manager, also at Odyssey, more than 10 years experience in various investment roles, worked with different companies, very familiar names in our solar industry, Trine, also Mirova Sun Funder, and it was also the head of medium enterprise at Jamir Bora Bank. I think overall, based on this more than 10 years experience, I think it's fair to say that you're by now an expert in deal origination, structuring, and advisory with a specific focus on renewable energy. And you got your degree from the McGill University in Canada. Ruth, Andrew, welcome to both of you. I have spoken enough for today, so I'm very, very happy to hand over to you and to share a little bit of your knowledge with our listeners today. Thank you very much.
Thank you so much, John, for starting us off and for the introduction. So I'm just going to take you through the webinar for today. And so it's all about becoming investor ready. And before we do that, just a quick overview about Odyssey. More than 2,400 renewable energy companies use Odyssey to either access finance, monitor their solar assets. We have more than $1.3 billion available for financing and more than 40 financing programs that are either concessionary or commercial in nature. And we also offer finance for equipment procurement. As you can see from the map, we are distributed globally with a focus in Africa, but outside Africa, we still have a presence in other countries. So people often ask, what is Odyssey? Odyssey is an end-to-end tech platform that works with distributed renewable energy companies on each and every step of the way. So to start with, we offer free planning and forecasting tools, which you can use to do some planning and forecasting and model various system capacities and generate some techno-economic analysis. Then once you obtain your techno-economic analysis and additional data from your planning process, you can share that directly with financiers who are on our platform and who specialize in investing in the distributed renewable energy space. Then once you have financing, you'll definitely need to procure so that you can put your asset in place. And for that, we normally aggregate demand across developers, negotiate with original equipment manufacturers or OEMs for better pricing and terms, and then we pass on those benefits to you. And we also offer some procurement financing for developers who have some constraints with their working capital with regards to purchasing the equipment. And then once your asset is in place, you want for it to, operate optimally. And for that, we have some remote monitoring and control solutions. And our hardware and software can be able to integrate with hundreds of OEMs. And that will help you to ensure that your asset is performing at its peak performance. So with that overview, we can now dive into financial modeling for the C&I space. So what is a financial model and what is important? Financial modeling basically is the process of estimating the investment performance of a business by taking into account all relevant factors and parameters that would drive that performance. And it's important because this is mostly the tool that investors will ask for. It will help you to speak the language of investors, and it will also help you to answer some key fundamental business questions that you may have, either as a developer or as a financier. And some of the components of a financial model are assumptions and drivers, financial statements, sensitivity analysis, and charts and graphs. And if you're not familiar with that, don't worry, we'll dive deep into that as we progress. And some of the uses of a financial model include valuation. So this is important when you're seeking equity and you're trying to establish the value of, say, a share price. You can do that using a financial model. Models will also help you with capital allocation. So there are various pools of capital, be it equity, debt, mezzanine grants, and a model will help you to optimally allocate that capital in a manner that will maximize your returns. They also help with budgeting, and budgeting is basically the process of allocating your resources in line with the constraints that you have. So like, let's say you have $1 million worth of capital and you have a project that you want to put. How will you allocate that capital to meeting the costs of that project within a given time frame? And then models also help you with doing forecasting. So forecasting is basically a look ahead exercise whereby you're trying to map out your expectations of the financial performance of the model of the project. They also help with monitoring, whereby you're basically just keeping an eye on the financial performance of your project as time moves on. And it's also important for you to carry out a variance analysis, whereby you're comparing your expectation versus reality, as it will help you to, optimize your operations and help you to also stick within your budget. And then models help with capital raising, which is actually why we are here. We want to learn how the model will help you in raising capital. As you said, it's the language in which investors speak. And then they're also important in mergers and acquisitions. So if you're looking at being integrated into another company, you can use a model to quantify the synergies and see how that merger will materialize from a financial perspective. And mostly financial models, when you're carrying out your financial modeling, we normally use spreadsheets, and the most common one is Microsoft Excel. So what are the key components for a C&I financial model? The key components are inputs, calculations, and output. And it's important for you to structure your model in this way because it gives a very logical flow, and an investor will be able to follow through the model. And for this session, we will be looking at modeling from the perspective of a developer who either engages their off-taker through a PPA contract or a PLA contract. So in a PPA stands for Power Purchase Agreement. In that agreement, you're selling electricity to your off-taker over, say, a period of 15 to 20 years. And in the case of a PLA, which stands for Power lease agreement. You are basically leasing out, as the name suggests, the equipment to the off-taker of a given period of time. And in that case, you'll have like a fixed amount that the off-taker will be required to pay, say, every quarter or every month, depending on what you've negotiated. And so just to dive deep into each and every component, the first one we have is inputs. And inputs are basically the numeric assumptions that drive the model. So as you are starting with defining what a financial model is, we stated that you're basically estimating financial performance by taking into account all the parameters. And the inputs will help you to capture all these parameters that will drive that financial performance. So for example, some of the inputs that you need are time-based inputs. So you can look at the pre-construction period. So the pre-construction period is basically the time when you are mobilizing all the resources that you need in order to put your project in place. So maybe you need a team, you need equipment, you need financing, you need licensing. You'll need to factor that in the pre-construction period. And we normally see that this takes roughly 6 to 12 months. Then you'll have your construction period, which is when you're now putting the asset in place on the site. And this again will depend on the size of the project and how fast you're able to execute as a developer. And then we have the operational period, which is whereby you're now engaging with the off-taker. Perhaps you're selling the electricity or you're leasing out the equipment. And that duration will be determined by what is stipulated in the off-take agreement. It could be 10 years, it could be 15 years, it could be 20 years. The other set of inputs are tied to energy generation. And so here are some of the inputs that you could have would be like the capacity of the plant. So maybe you have one large project that is, say, worth 1 megawatt peak, or you have multiple projects that are, scattered, but yeah, you'll need to ascertain the number of sites and the average size for each site. You'll also need to use the yield. So you could either use a P50, a P75, or a P90 yield. We tend to see developers preferring the P50 yield because it gives the most amount of energy output, whereas we tend to see that financiers prefer using a P90 or a P99 yield because it's conservative and it just takes into account the fact that you won't have sunny days throughout. That days when you'll have cloudy days and you won't be able to optimize on your energy generation as much as possible. And then you can also factor in the degradation rate, which, because as you know, with solar panels, the efficiency declines with time. So like the output that the solar panel was giving when it was brand new, it won't be the same 5 years or 10 years down the line. The other set of inputs you should take into account are development and operational costs. So under development costs here, you'll take into account capital expenditures, which is commonly abbreviated as CapEx. And these are all the material costs that you need to put the asset in place. So like the cost of the equipment, the cost of licensing, maybe some transportation cost and all that. So you'll need to factor that into CapEx. And then operational costs are now, once the asset is in place and you're engaging with the off-taker, you'll need to maintain that asset. You'll need to perhaps incur some insurance costs, some selling, general and admin expenses. So those are just some examples of operational costs, which are also abbreviated as OPEX. Then another set of inputs are financing. So before you start out your project, perhaps you notice that you will have a funding deficit and you have like financiers who are targeting. So you can try to map out like the key terms that investors are likely to offer you. So for example, if you're looking for debt, you can look at, say, in this particular market, debt financiers offer this particular type of interest rate. I'm seeking a loan for this tenor. This is how I envision the loan will be sized, and this is how we envision repayment. And then for equity, you might perhaps look at a lock-up period whereby investors are not allowed to, get paid using dividends. But once the dividends start flowing in, that's when they'll be able to recoup the investments, and you can have assumptions tied to that. Then another set of assumptions that you should take into account are revenue and pricing assumptions. And here, this will be driven by the offtake agreement that you have with the end user. So for example, if it's a PPA, you'll need to have the tariff, and probably the tariff will be quoted on a per kilowatt hour basis. If it's a PLA, probably it will be a fixed amount which the offtaker has to pay every month or quarter, depending on what you've negotiated. And also, if you envision that your revenue or your price will be growing by an inflation rate or an escalation rate that you've negotiated in the contract, you should factor that in. And then other set of inputs would be tied to working capital. So like, how long do you go before you receive your payments? How long do you go before making a payment to your suppliers? Some macroeconomic assumptions, so like what is the inflation rate that the costs that you are likely to incur will be growing at, and what are the key tax assumptions and variables. Then the next component of our financial model are calculations. And this is where the logic of the model is built and when you're carrying out your forecasting exercise. And in this part, we encourage you not to mix your inputs and your calculations. It's important for you to have them separately. So there are quite a number of calculations that go through in a model. So you could have calculations tied to revenue generation, tied to costs, tied to taxes, tied to the asset value, and so on and so forth. So on this slide, this is just a sample calculation. So for example, let's say you want to ascertain your revenue. So how you're going to do about it is you're going to first establish your capacity. So perhaps you have multiple projects. You can take the number of the projects that you have and multiply it by the average size per site. Then you can ascertain your net energy generated, whereby you take the capacity, multiply it by the yield, and factor out degradation. Then you'll also take in your tariff and then grow it by the inflation rate, be it quarterly or annually, depending on what the contract says. And then for you to now obtain the revenue for that particular quarter, you'll take the forecasted tariff and multiply it by the net energy generation. So yeah, this is basically where the forecasting is done, and this is where all the calculations basically are held. And then the next component of a model is the output, and output basically informs on decision making. So when you're starting out the exercise, you had a fundamental business question that you're trying to answer, and the output will help you to answer that question. And so we will go deep into each and every one of the outputs that you can see on your screen as we answer the question, what are the main outputs that financiers typically look out for? So the first set of outputs that you'll need from your model are the financial statements. So in those statements, you'll have the income statement, which is basically a statement showing whether your project or your company is making a profit or a loss. So basically, you'll take all your revenues, deduct all your costs, and then whatever remains is either a profit or a loss. You'll have your balance sheet statement, which basically shows the net worth of the business. So it will have the value of the assets and how these assets are financed. So were they financed by debt, by equity, and what do those portions look like over time? And then you're going to also have your cash flow statement, which basically shows the flow of cash from operating, investing, and financing activities. And it will also show the balance of cash over each period that is projected. And the reason why financial statements are important is because investors use them to do analysis to ascertain the strength of your project. So for example, they can do a ratio analysis to see if your project is generating profits in an efficient manner. They will do some analysis to see whether your project is over leveraged or under leveraged. They will also want to see, perhaps they can carry out some cash burn analysis to see how long can your business sustain itself from operating activities before you go out to look for external funding. So financial statements will help to answer those kind of questions. The other output are investment KPIs. So a KPI stands for key performance indicator, and this basically is what informs the go or no go decision for an investor. So if you are approaching an equity investor, for example, some of the KPIs they will look out for are the project and equity IRR. The IRR stands for the internal rate of return, and basically it's a rate of return that shows the profitability of a project based on the cash flows that the project has generated, and it will also take into account the timing of how that cash flow was generated. And how investors use this is that they'll compare it against a hurdle rate. So the hurdle rate is the required rate of return that compensates investors for the risk that they're undertaking in the project. So if the IRR is above the hurdle rate, that's a good decision. But if it's below the hurdle rate, they might have some second thoughts. The other key parameter that they look out for is the NPV. The NPV stands for the net present value. And, as I've said, modeling is a forward-looking exercise. So basically, you will take all the forecasted net cash flows and discount them as at today using a discounting rate. And if the NPV is a positive value, it shows that your project is able to generate value. But if it's a negative value, it shows that, the project cash flows are basically not creating sufficient value in tandem with the risk that has been taken. The other metric is the return on equity, and this is basically your net income divided by the value of equity. And it's just a measure of profitability, efficiency. And then also another metric that equity investors tend to look at is the multiple on invested capital. And this is basically the total value that the investor will generate from the project divided by the value of investment. So the higher the multiple on the invested capital, the better, because it shows that the investor will not only recoup their capital, but they will also obtain additional returns. And then if you are approaching a debt investor, their key concern is, can your project cash flows repay me? And so some of the metrics that they will look out for is for the debt service coverage ratio, which is abbreviated as DSCR. And basically, this is computed by looking at the cash flows which would be available for debt service, and then it will be divided by the debt service as it falls due. And so how investors use this metric is that they will have a covenant, like the minimum threshold. And so if the DSCR throughout the project life is above that covenant, the investor will feel comfortable because it gives them comfort that these cash flows are sufficient to meet debt service as it falls through, as it falls due. But if it's below that covenant threshold, then they might be jittery about it. Then debt investors also tend to look at the amount of leverage in the project, and some of the key ratios that they look at is the loan to value and the debt to equity. So the loan to value is basically the value of debt divided by the value of assets, and the debt to equity, as the name suggests, is the value of debt divided by the value of equity. So in our project finance setup, we tend to see that investors can accommodate a lot of leverage because of the risk sharing capabilities within that structure. And we tend to see a leverage ratio of, say, a loan to value of, say, 70 to 75%. And this could be higher just depending on the risk appetite of the investor. Then they will also look at the strength of the cash flow to service key reserve accounts, such as the debt service reserve account, which is abbreviated as the DSRA, and the maintenance reserve account. So for the DSRA, basically it's an account which would have a cash balance that can service as a given amount of debt. So maybe perhaps depending on how you negotiate, that account should have a cash balance that can service debt, say, for the next 3 to 6 months. And same case for the DSR, for the MRA, whereby the account will be required to have a cash balance that can cover your OPEX expenditures, say, for the next 3 to 6 months as well. And then last but not least, the other key output are the scenario and sensitivity analysis. And this helps in the evaluation of risk by showing the impact and magnitude of varying a key risk input on a key output. And how I see developers use this is, perhaps you've approached an off-taker and you want to give them a competitive price. So most developers will, say, for example, give a discount of 10 to 40% from what the national utility company is giving. And so using a scenario and sensitivity analysis, you can look at how low can you go on your tariff without adversely impacting on the project economics. And then also for investors, they tend to like using sensitivity and scenario analysis to carry out worst case scenario. So like, for example, in your base case assumptions, let's say you assumed inflation would grow by 5% each year. So perhaps an investor would be curious, what if inflation grew by 10% or 20%? Will I still be able to get the kind of return that I was envisioning? So yeah, those are some of the sensitivities, for example, that an investor can carry out, and also you as the developer. And so what are some of the common mistakes that we see developers make when putting together a financial model? The first one is not adhering to best practices when building a model. So as we've given you the flow, it's important for you to have the inputs, calculations, and outputs, in that order, because sometimes we tend to see that developers can have the inputs mixed together with calculations, or perhaps the formatting is not consistent, and it just makes it harder for someone to follow through the logic of the model. So it's important for you to just adhere to best practices. The other mistake we see is building large, complex, and overgranular models. And we tend to see this especially when a developer engages a consultant. So perhaps your core strength as a developer is to do the EPC and O&M work and not financial modeling. So you engage an external party, and perhaps they're trying to justify the value of the fees. So they really build some really large models. And sometimes this might work against you because during due diligence, the investor will take time, to try to understand all the complexity behind the model. And sometimes they might even decide to build a simpler model on the side so that, they can be able to do the analysis in a more faster way. But now this detracts from the due diligence duration. And then on the other end of the spectrum, we tend to see that developers build oversimplified models with insufficient robustness. So like, your model should capture all the key commercial terms in the EPC contract, in the O&M contract, in the offtake agreement. You should capture all the macroeconomic, environment assumptions and all. So it's important for you to build a robust model so that it can be able to inform better on the financial performance. And then the other mistake we tend to see is using overly optimistic assumption. So like, for example, as I had said, when it comes to yield, whereby developers prefer using a P50 yield, whereas a financier will prefer seeing a P90 or a P99 yield. And then the other mistake is, in the event that you do have your historical results, they're not factored in as a baseline for projections. So for example, let's say historically your revenue has been growing by 10% per annum, and then you're projecting that they'll be growing by 30% per annum. Like, an investor will be curious about that disconnect, like what exactly is changing between your historicals and your projections. So it's important for you to use those historical results for you to ground your projections into reality. And then the other mistake we tend to see is hard coding non-input cells, and this tends to affect the sensitivity of your model. So for example, if you mix your inputs and outputs and you're trying to carry out a sensitivity analysis, you might not get the correct form of output because of hard coding. And with that, I'd like to now pass on to my colleague, Andrew, who can inform us better on how we can be investor ready.
Thank you very much, Ruth. Having looked at some of the things that investors look for when assessing opportunities, what we want to touch on for the next few minutes is the different types of capital available to developers based on the stage they may be in the life of their business, and as well what it takes to be investor ready. In this particular slide, we're talking about, excuse me, in this particular slide, we are talking about the financial instruments available to developers. So we've broken them down into three: long-term capital, short-term capital, and then what we call credit enhancement. From a long-term capital perspective, we're talking about long-term loans, bonds, equity, mezzanine. These are offered by DFIs, special funds, private equity players, large asset owners, crowdfunding platforms in some cases, or crowd equity platforms in some cases, as well as international banks. When we talk about short-term capital, we talk about inventory finance, working capital, guarantee mechanisms, as well as letters of credit, mainly offered by local banks and regional banks. And then, of course, the third perspective here is what we call credit enhancement. These are tools that are used to de-risk either projects or companies directly, and they could be offered by insurance companies or through DFI partnerships. Ruth, if you can move to the next slide, please. In terms of being investor ready, I think this is one of the most important discussions that a developer needs to have internally, either from a board level or even from a management level. If you're not able to address these concerns before you approach investors, in most cases, you end up having the wrong instrument provided to you and probably working with the wrong investor in the long run. When we talk about defining the types of financiers most suited for your business, we need to look at where you are in terms of the life cycle of your business. So if it's an early stage developer, maybe what you require is early stage equity or grant financing, which will come in the form of angel investors, private equity funds, or venture capital partners or venture capital funds for that perspective. Grants coming from DFIs and other multilateral organizations, depending again on the business model that you have. At the same time, you need to be able to develop a compelling narrative for the financiers. You know, what sort of challenge are you looking to address? Is it a solvable challenge for that matter? Is it a marketable challenge? Is it scalable? Is it sustainable? And then most importantly, is it impactful? Let's not forget that we are addressing the needs from a renewable energy perspective. So impact plays a big role in terms of attracting the right capital, the right type of capital, and the right type of investor for you. You need to be able to demonstrate use of funds. What is the capital going to be used for? Is it CapEx? Is it OpEx? Where are the funds going to be deployed? Can they be deployed directly to suppliers or manufacturers, for example, in cases where you want to avoid divergence of funds? For example, are they for inventory? Are they for expansion purposes? So there are many questions that need to be answered when you're looking at demonstration of use of funds. And then having an easy to share data room. Investors need to know what your business plan is, what your company is about, what your plans are, what the projections you have. So the data room needs to capture certain things. It needs to capture a very clear pitch deck or in a investment memorandum. It needs to capture the KYC documents. KYC documents know your customer. You need to be able to tell them about yourselves. You need to know that you're a legal entity that has the right to borrow, for example. The financial model, we've touched on it previously in this discussion. So you have to have a very clear financial model available to investors. You need to show the operational structure of the business, as well as any legal docs or documentation that has been executed, whether it's shareholder agreements, existing loan agreements. Are there any NDAs that have been signed with different entities? Are there partnership agreements, for example? And then funds should be set aside for specialist advice. Here we're talking about legal advice, accountancy, tax experts. At any point in time, depending on the structure of capital that you're looking at, depending on who you're raising capital from, you will need advice from a legal expert, from a tax advisory expert, regulatory expert. So there always needs to be a buffer in terms of cash set aside to cater for those experts. And then a healthy dose of patience. Different capital providers have different processes. They have different timelines that they undertake. A local commercial bank might be able to turn around an application in, say, 6 to 8 weeks. Whereas if you're talking to a private equity fund, they have an analysis process that could probably take up to 6 months, in some cases longer. So it goes back to the idea of knowing what sort of capital you are attracting, which stage you are in your business life, so that you approach the right investors. So always have that understanding. It also guides the level of patience that you need to have. At this point in time, I'll hand it back to Ruth to take us through the financial model, now the financial tools for modeling that we've created at Odyssey.
Yeah, thank you so much, Andrew, for equipping us with that knowledge. And so like one of the challenges that we are trying to solve for in the distributed renewable energy space is like when you have multiple small projects that an investor would not even typically look at, and our platform will help you to aggregate those projects into becoming a sizable portfolio that an investor would be typically interested in, like a commercial investor in that case. So once you log into our platform, you'll have a customized homepage. So this is just an example. Then you'll come in over here to plan and go to C&I sites. And we give this offering in order to help developers to generate financial models that are able to, be reviewed by investors. So for example, these are just some dummy projects. We can look at this one. So under this particular off-taker called Pink Flowers Limited, they have 2 site groups. So in this first site group, the grid configuration is that it's grid-tied, battery storage, and it has diesel generation. And also the currency is in US dollars, whereas for the second site group, the configuration is just doesn't have the diesel generator, and the currency is different. So if you have an off-taker and perhaps for different sites you have different terms, you can be able to group them under a site group. So we can have a look at one. So yeah, it's just loading. Yeah, so as you are talking through in the presentation, you'll need inputs which will inform on your financial outputs. So for example, on our platform, you'll be able to key in your key inputs in this particular interface. So for example, under project fundamentals, you'll put in the size per site, the capex, the degradation rate. When you estimate, you'll start construction and the pre-construction period. And then over here, you'll be given a chance to dictate how you want this capex to be spread out over the pre-construction period. So if you say yes, it will be evenly spread out. But if you click on no, you'll have the opportunity to customize how you want this capex to be incurred over this pre-construction period. Then on the PV production, you'll be asked to input your PV production. And this is where now you can put in your yield, your energy yield, and then also how you envision the production to happen each quarter. So if it's yes, it's going to be even in each quarter. But if you click no, you can again be able to customize it based on perhaps the seasonality that you've done, seasonality factors that you may have observed from your prior feasibility studies. And then over here under customer consumption, you'll be required to put in the energy that the customer typically will likely consume. And then again, you'll have the opportunity to customize it for each and every quarter. And then under the revenue assumptions, you can put in the length of the contract. It could be 10 years, 15 years, 20 years. And then the blended tariff charged to the customer. So as you remember, for this particular site group, it's configured to the grid, battery, and diesel. And so you'll have to charge a tariff that's blended, having factored in those different sources of energy. And then depending on the structure of your contract, so perhaps you'll be able to pass through inflation. So you'll click yes. But if that's not the case, then you'll need to factor in those costs in your projections. So you can factor in a tariff escalation depending on what you've negotiated in your contract, how you envision operating expenditures will grow. And then the other question you'll be asked is if it's a take or pay contract, you can either answer yes. But if it's no, then you'll be prompted to put in additional inputs. So like over here, you can put in the energy production that will be stranded per site and the feed-in tariff from the grid. And then depending on who's responsible for grid connection, in most cases it's the off-taker, but if it's you as the developer, you'll be prompted to answer in a few more questions on whether you're supposed to also meet the consumption of the off-taker. And then you can put in the maximum percentage of consumption that should be met by the grid. Because it also has a diesel backup, you'll be required to put in the cost of diesel and the price of grid consumption. And then on the expenses, you can put in your operational and maintenance expenditures. and your insurance and selling general and admin expenses that you estimate. And then down here, you can put in any additional comments that you'd want your investor to keep in mind as they go through your model. So once you're satisfied with the inputs, you'll click here on Save Changes, and the portal will number crunch and it will generate for you a financial model. So this particular overview, it gives you an output, the outputs that you are talking about in the presentation. So like it has an overview of like the fundamentals of the projects and also some key financial highlights. So for example, here's the IRR, here's the payback period, like basically the period when the investor will recoup all the investments. And then we also have some visualization. So like this chart shows like this is the point where you'll be able to break even. And then this is how your energy breakdown based on the production will be generated. So in this particular example, it's 90% solar and 10% from the grid. And yeah, because the consumption and the production were in equal use, the diesel won't need to be used. But if, say, the consumption was above, perhaps the diesel backup would have kicked in. And then you can also see the energy mix per quarter in terms of kilowatt hours and a breakdown of the expenses. So another thing that you can be able to do on the platform is carry out a very quick sensitivity analysis. So in this particular example, our capex is $11 million and you have an IRR of 24%. So perhaps you could be curious of what if my capex, let's say, increases by $2 million, so from 11 million to 13 million, what impact would that have on my IRR? So yeah, the portal will be able to do the number crunching on the background. Yeah, just doing the calculation. Yeah, so now it's done and the financial model is updated. So you want to click on this tab, you'll now be able to see the impact on your IRR. So we've seen that a $2 million increase in capex has lowered our IRR by around, I think 2%. So once you're okay with everything, you can click on download financial model. In the interest of time, we had actually downloaded a sample. So we can just show you the model that will be generated. So yeah, over here we'll have the key highlights of the dashboard. So like an investor can be able to have a quick glance and decide whether this is a project they're interested in or not. So they can look at the IRR. Is this above their required rate of return? And then over here we can see the dashboard that was available on the platform. And then, yeah, we've separated our inputs from our outputs. So in the inputs, these are the things that you're able to input on the portal. Yeah, they are separated with regards to their font in blue and green. And then when you scroll further down, you'll be able to see the calculations, which, as we said, is the logic behind the model. And so like, yeah, here we have the logic of the model in the form of calculations. And yeah, with that, I'd like to hand it over back to John to facilitate the remainder of the session. Thank you so much for listening.
Thank you very much, Ruth and Andrew. Quite impressive, quite comprehensive also for, I think both for people who already have experience with project financing and getting CNI projects financed. It was a good refresher. And then also for people who might be new to the field, I think you've explained really step by step and in a very simple way. You know, generally financing is made scary, it's made mysterious, but I think you managed to do it in a very accessible way. Thank you very much for this. We have questions from the crowd. I have some questions of my own, and if you don't mind, while people are submitting a few more questions, I would like to ask you one question of my own first. Who can access this financial model that you just showed on your website? Is it freely accessible for anybody, or is there some fine print somewhere?
Yes, so the tool is actually freely accessible to developers on the platform. So all you need to do is sign up with Odyssey. We'll create an account for you, and you'll be able to access all those planning tools for free, and you'll be able to generate your model and share it with investors who are signed up on the platform.
But then I have another follow-up questions. I'm sure that many of the listeners here who have ventured into getting their projects financed have been in touch with one of the many financial advisors, which you referred to in your presentation as well. But these people sell this kind of knowledge. You make it available for free. Where's the catch?
So yeah, perhaps Andrew can take that.
There's no catch. We are simply trying to provide a service. We see ourselves as the middleman. There's a need for finance, so the financiers or capital providers themselves have a need for pipeline that they need to finance. We are able then to provide them with a pipeline. At the same time, we're able to put the developers in front of the right financiers for themselves. So this is more or less a value add that we are offering to the market, obviously based on whatever agreement we'll come up with the individual developers and the individual financiers. There's a structure from a fee perspective, but for now we are happy to offer these services free of charge.
I'm sure this will sound very interesting in the ears of the listeners today. Some questions from the crowd. Yassir is wondering if there are 50 different small sites. Does Yassir have to put in the details for every single site, or should he take the average of the sites, or how should he consider the portfolio approach and the solution that you have shown?
Yeah, so there's actually flexibility on how you can do that. So with the version that I've shared with you, you can take the averages of all those sites. But if you would want to capture each and every nuance of the site, you can be able to actually just put in all the inputs, though it's going to be a lot of work. Then once you've done that, you can aggregate that into a full portfolio. Yeah, just in case you'd like to capture in all the nuances and the details of all your projects. Yeah.
Somewhat of a tricky question, but then again, it comes back over and over again. So you have the model, which is done in a specific template, very easy to use. And then once everybody agrees on the model, then the big discussion comes about the assumptions. And Samuel is wondering what key considerations should be included when looking at the discount. How can people get over that discussion? Or what is your recommended approach?
So just to see if I've understood you, it's like, how do you like defend your assumptions before investors, if I've captured it correctly?
Yeah.
Yeah, so like, yeah, we do tend to see that investors in this sector are quite sophisticated, and for sure they will need to check whether your assumptions are aligned with reality or if they're just over-optimistic, because as a developer, you want the project to show the best returns, but as an investor, they will look at the downside scenario. So yeah, they will try to see if each and every assumption that you're putting in is grounded on something. So like, for example, if it's your revenue-based assumptions, have you like signed an offtake agreement, or are you in the process of signing that offtake agreement? They will also perhaps do an analysis comparing the national grid price compared to what you're offering, so that they can be able to assess whether the off-taker will be motivated with paying that tariff as it falls due, because at the end of the day, you're giving a saving to them. Then if it's with regards to your CapEx, the capital expenditures, the key one is tied to engineering, procurement, and construction. And for that, they can look at the terms in your EPC contract and whether they are protecting you as a developer, or whether you are perhaps liable to, I don't know, like, yeah, penalties and the like. So they will try to look at whether all those assumptions are grounded. And then also for the O&M, they will O&M operational and maintenance costs. They will look at the O&M contract, whether you've pegged in whether you've locked in that rate, and also the penalties that you're likely to accrue as a developer should you not be able to meet those prices. So yeah, investors will look at each and every assumption. So for each and every assumption that you put, just make sure that it's grounded on something, either a contract or the prevailing macroeconomic environment.
Thank you very much. And I'm getting bombarded with comments, questions. Most of the comments are really, really thankful for the clarity and the simplicity of the explanation. So I think this is a recurring theme, really. There's like really two sides on this equation. There's the people developing projects, there's the people financing the project, and it's not always simple to speak the same language. And I think what you have developed at Odyssey is going to greatly contribute to make those conversations on a more equal basis. And this is what listeners are also sharing. About the model. So you have developed one template of a model. Then again, there is tons and tons and tons of different templates, different models. Is there such a thing as the ultimate financial model? And then a secondary question to this: how recognized, how accepted is the model that you generate through your platform by the financing community? Do you have some agreements in place already? Can you say we are working with this and this financing partners? They love our model. How should people consider your model?
Oh yeah, that's a good question. So on the first one, on the ultimate model, so definitely we constantly actually work on improving the model each and every time. So for example, the model that I showcased is actually a version 5. So we went through 4 other versions, because what we do is we constantly take feedback from developers and investors as well. And when we see that a particular feature has a lot of demand, we liaise with our engineering and product team to have it integrated on the platform and on the model. And so, for example, some of the key things that you're looking to roll out to developers is, number one, we are coming up with like a site tool kind of model, which will help developers develop a model that will help them to negotiate with their off-takers. So like, it will help them to assess, like, these are all the costs that as a developer need to incur. So how do I set my tariff in a way that will be able to make me a profit and at the same time give the client a saving? And then another tool that we are developing and we will be launching soon as well is that you'll be able to aggregate all those particular site group models, like the ones that I've shown you, into our portfolio model. And this will be able now to like aggregate all the cash flows into one model, and it will be more robust. It will have all the financial statements and the like. So yeah, there's no ultimate model, but as Odyssey, we are very keen on improving, and we keep increasing our offering to developers, and we're very much open to feedback. And then on the second one, on whether the model is accepted by the financing community, not to brag, but like in the commercial capital team, we are quite experienced. We have our counterpart in the US who worked with IFC for over 10 years. We have Andrew, who's been in the renewable energy space for more than 10 years. And same case, actually used to work, for a fund manager. And so I know what investors tend to look out for. So we combine all these experiences that we've seen having worked with financiers themselves, and we factor in all these aspects that investors are very keen on seeing. And so our models capture all that, and even when you share them with investors, we know the key metrics that they're looking out for, and so it will help them in their investment decision making. And yeah, so far we have some developers have actually used our tools, and they've used it in their capital raising, and there are quite a number who've even progressed with their appraisal stages. And yeah, so far none of the investors have complained.
The next question comes from Sustan from Malawi. How long would you say it takes to input the data and analyze, for example, for a single 1 megawatt peak project?
It depends. So our platform, as you've seen, it's very standardized. It's very easy to use, and how long it will take you is it's basically dependent on how readily available your inputs are. So for example, if it's your very first time being a developer, As I've said, you need to ground all your assumptions in some sort of reality. Perhaps it could take you time because you need to go out there and negotiate for your contract, see what the market is willing to pay as a tariff or as a lease fee. But in the event that you have all those contracts in place, to be honest, it could even take you 15 minutes. Yeah, so it would only be a challenge in the event that you don't have all the documentation and assumptions that need into going to building a model. And in that case, just remember that we are here for you. We are quite accessible and we have a sector expertise. And so we'll be able to help you to come up with your assumptions and tell you what we've seen in the market. So yeah, we are really available to help.
And talking about this help, and maybe this is a question which is more directed to Andrew, who told us a little bit about the different types and sources of funds. Aside from helping with the financial model, is Odyssey also helping with putting a developer in touch with financing parties? Because now we have discussed the financial modeling. Okay, I have a project, I have the data, I get the financial model and everything is nice. Who do I talk to? Who do I know? Which are the right partners for me to talk to, and how do I get access to them?
Yeah, thanks, John. Yeah, the discussion starts with us at Odyssey. So once you update the platform with your information, we review it internally first. And then based on business model, business plan, financial model, the project itself, and what the client aims to gain out of capital fundraise, we would then present, say, 3 or 4 financiers to the client and then say, look, these financiers might be interested. This is a structure that they offer. And it doesn't stop there. Even as we introduce the developers to the financiers, we work with the developers all the way from the initial discussion to the point of disbursement of funds. So if there are any clarifications that are required from financiers, we're also involved in that discussion. Yeah, so we were more than happy to guide. That's one of the key roles that we offer and provide.
And as a follow-up question on this, just very timely question from Abigail. What is the cost for you to do this and to provide this support? Is there like a rate card, or how do you work?
It generally depends on what service that we are offering. So, ideally here we are in an advisory role. So if we are providing a pipeline to the financiers, we engage with the financiers in separate agreements. So we have our own arrangements, fee-based arrangements with the financiers. When it comes to developers themselves, again, it just depends on what services we're offering the developers. In most cases, the initial services are free. But then if it follows on and they want to access some of our specific products, such as remote monitoring and control solutions, we assist with procurement solutions. Those can be done then on a subscription basis or again on a fee-based solutions.
Yes, that procurement solution that you just mentioned, that will be for another session, because this is also another very cool feature of your platform. But we need a few more hours to talk about all the different services. I'm looking at the clock. We're almost at 11. I want to take a few quick last questions. And if you do have a last minute question, I can already tell you we will not have the time to address it, but please submit it because they will be shared with Ruth and Andrew so that they can follow up with you and address your questions after this session. But for now, Santosh and Akram have a very similar kind of question. Does the model only cater for project finance projects, or can it also be used for developer finance, between brackets, working capital?
Oh yeah, so for now, the model only caters for the project finance type of structures, but as we said, we keep launching in more tools. So yeah, we have received quite a number of requests to also cater for working capital type of models, and we're actually working on it together with our product team. So stay tuned, we'll be launching it as well.
David is wondering, is the financing agreement directly between the financier or the developer or via Odyssey?
It's directly between the financier and the developer. We introduce the developer to the financier. As I said, where we bring pipeline to the financier, we have our own independent arrangement with the financier, and then we collect a specific fee from the financier. But from a legal perspective, interaction is between the financier directly and the developer.
And then maybe last question before we close for today, a question from Amanda. We've seen the template for CNI projects. Do you have templates for other kind of solar specialties like solar home systems, distribution, mini grids, e-mobility maybe?
So we cut our teeth specifically in West Africa with mini grid projects. So that was the bread and butter for Odyssey for the longest time. We've run programs for the likes of World Bank, SE for All On, and now moving into CNI. So the templates we do have specifically are for mini grids as well as CNI, but we are actively looking at electric mobility. So that will soon be developed. From an SHS perspective, it's not that different from mini grids because of the collection metrics, but haven't really looked into that deeply. But yeah, it's mainly mini grids, CNI, and now actively looking at e-mobility.
Also very interesting to hear, and we can't wait to see those new templates coming up and be made available very soon. Thank you very much. This brings us to the end of our presentation today. I want to thank you both once again, and thanks Elisa also for arranging this session today. I know you are listening in as well, and of course a big thank you to everybody who made some time today to join us live. Before I let everybody go, I would like to do a little bit of self-promotion about upcoming events. We have some very, very cool things coming up in the next few weeks and in the next few months, and I would like to tell you about this. First of all, we'll have another online session about the latest developments on the CNI storage solutions with Nick Lawson from Huawei. That will be on December 7th, also an online session like today. And then for next year, we have some amazing events coming up, several of them in Nigeria. So first of all, we'll be at Paralec, Nigeria in February. So this is a massive exhibition and conference taking place in Lagos from the 20th till the 22nd of February. Later on that year, we will be again in Lagos, but in November this time with our traditional REFA conference, so Renewable Energy Forum, really being the ultimate matchmaking place between project developers and financiers, so very similar to what we have discussed today, but in a more one-to-one and live setting. We will also organize the AVSIA Awards at that time. So a big celebration of the big winners of the years in multiple categories, always a big party. And finally, I would also like to tell you about the launch of our Solar Training Tour Africa. So we will be touring several cities across Africa, really coming to meet local EPC companies eager to learn about the latest technologies, the latest best practices for installations, for equipment, and bringing together OEMs and people who are developing and building projects on the ground, just to make sure that everybody has the latest knowledge and the best capacities and capabilities to build wonderful solar projects for happy customers. So this is it in a nutshell for what's to come on AVSIA side. Once again, I would like to thank everybody for joining us today. I hope you enjoyed the session, and we will be back in touch very, very soon for more information about solar in Africa.